General Mills is a leading global producer and marketer of consumer food products with over 150 years of history. They operate in 100 countries across 6 continents, with more than 100 brands. Let's dive into the company's financial performance. It is evident that the company's revenue heavily depends on global economic conditions. Net profits also do not show a consistent growth trend. The company's assets are gradually increasing, but its debts are also growing, though not as quickly. My final rating for this company is 6 out of 10. The company has broad diversification in the products it sells, with most of its revenues coming from several sectors, including snacks, ready-to-eat breakfasts, convenient meals, pet foods, refrigerated and frozen dough, baking mixes and ingredients, yogurts, and super premium ice cream. They have several popular brands like Cheerios and Chex. 62% of U.S. adults have a favorable opinion of Cheerios, followed by Chex cereal at 49%. In 2021, they sold 139.1 million boxes of Cheerios, which is approximately 381,000 boxes a day. Unfortunately, in my opinion, although the company has a large portfolio, it does not have powerful brands that can stand next to these two. On the positive side, they have joint ventures with Nestlé, which produce and distribute both companies' products in 130 countries around the world. I rated the company 6 out of 10 due to its wide diversification. While it operates in many sectors, it is a leader in only one, which is ready-to-eat breakfast. The company is trying to find new sources of revenue, but it faces high competition from giants like Kraft Heinz, Nestlé, and several other major producers, making this a challenging task. Currently, one share of the company costs about $64, or $36 billion in total, which I think is a reasonable price. The company has many brands and a diversified business, so its revenue is not at risk. However, we have seen a decline in sales from 2012 to 2017 due to slow economic growth in the US and around the world. I believe a similar period might be approaching for the company now. Unless the US economy collapses due to military expenditures and the costs associated with servicing new debt, it certainly will not grow at a dynamic pace. We can see that the company took advantage of the near-zero interest rates in 2020 to take on $1 billion in debt, which they used for dividend payments and debt repayment. However, this may lead to challenging times ahead for the company. Firstly, they can no longer roll over old debt with new debt due to high interest rates. Secondly, I believe that their revenues will decline in the near future. Because of these factors, I am not very confident about buying this stock at $64. If the company's stock were priced at around $55, I might consider adding 0.5% of General Mills stock to my portfolio. I can say for sure that the company will not disappear, and there is no need to panic if you buy it today. You can still make money, but given the reasons I've mentioned, I think now is not the time to buy, but don't panic sell either. Subscribe to my channel so you don't miss my next videos.